Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're breaking down VistaShares OMAH, better known as Omaha. It's a 15% yield, and I'm asking here, is it a yield trap or is it good for retirement? I've done this review numerous times. I personally own Omaha. I bought it when it first came out, was excited about it, thought it was going to be something unique. But let's do a deep dive into this to find out how well this fund actually is done, where it sits today, and what are we seeing down the road? Is it the yield trap that a lot of people think, or is it the good retirement investment that we can be part of? So grab your mug, fill it with your favorite beverage, sit back, relax, and let's get into today's video. Important disclaimer, this content is for educational and entertainment purposes only. This is not financial advice. Past performances do not guarantee future results. Hey, before we go, if you don't have yours, don't be afraid. You can always order one. Retirement made easy, living on dividends, coffee mugs. We got the 11 ounce, we got the 15-ounce Big Daddy. All of this goes to support the channel. You can go ahead and hit that look at the QR code, or you can go down the link down in the description, click on that, take you right to the website where you can order this stuff and they get it shipped out to you ASAP. Now, for all of you, this is the big one, and this was the reason for it. The 40-ounce travel mug. It's great for inside your car. It holds warm or cold products. It's got a great easy storage handle. The reason for it is it's right here, this sip resistant and lid straw. I will tell you straight out what happened. I went to my truck with my mug. I dropped it on the driveway, shattered all the way across the board. I was upset, and I said, why don't we have mugs? And someone else on the channel also asked for the same thing. So we came up with these. We got them in. We're ready to go. If you want to get yours, get them now. So VistaShares Omaha, the Berkshire exposure and a 15% targeted dividend. That was the big push of this thing, was Berkshire. It's the Warren Buffett package. It's going to follow what Warren Buffett's doing. And we're paying a 15% target. Remember what target means out there. If you've been watching my channel, you'll know. Target is just like in darts. You shoot at the target. You're trying to hit the bullseye, right? Well, they're trying to hit 15% dividend across the board, using everything that Berkshire Hathaway has basically been doing. So what is Omaha as we know it? It's an actively managed strategy. Omaha from VistaShares is unlike a passive index fund. The advisors selectively and actively select the weight and manage the option overlay to meet the specific yield target. That is critical. Okay, and I'll explain that again. It manages the options and the overlay of those options to meet that yield target. It combines a concentrated portfolio of the Berkshire Hathaway public holding plus direct Berkshire Hathaway point B shares with the options overlay designed to harvest premiums. So basically what I'm trying to say is when you come back with option overlays, okay, is they're letting the funds, they're letting everything inside the package to grow while they're selling options overlaid on top of that. It's a dual investment objective. The primary goal is to generate that monthly income for investors. The second is to seek long-term capital appreciation through equity exposure. But right off the bat, they say they will pay you 1.25% monthly targeted amount. Means they'll pay distributions totaling about 15% annual throughout the year. So everything on the surface looks strong, looks good. Let's take a snapshot underneath the hood what this fund is. Came out in March of 2025, so we're a little bit over a year old already. Net assets, they are so close to $1 billion already, $958 million. So liquidity is not a question in play here. Very strong package in assets. Their targeted yield, 15%. Monthly payments. Their current NAV is $19.04. The marketplace, $19.06. So it's trading above as a premium than their NAV. Expense ratio, though, it's an active cost of 0.95, a little bit high in my opinion for what they're doing. But it is a select SEC yield of 0.69. That 0.95 expense ratio is significantly higher than passive Berkshire index trackers. The premium covers that active portfolio management and the complex options overlay required to generate that 15%. So in layman's terms, guys, that just has a higher cost because you have active managers doing it and they got to get paid. Now, why did I say that almost $1 billion on their asset management? Why was that so exciting to me? When this thing launched in March, it's opened up with $5.4 million under its belt. By December, it was already up to $682 million. By February, it only added less than $6 million since February. But from March, April, May, June, and now in July, they've gone from $688 million all the way up to $958 million in the bank. So they are aggressively growing their net assets, which means there's more interest in the fund. There's people starting to drive towards this fund, which is why we want to do a deep dive to find out. The growth drivers in the reality check, that high 15% targeted yield, monthly cash flow, okay, is a mass investor interest. The strong association with the Berkshire Hathaway brand creates that immediate trust, and the increased scale provides liquidity and fund operating efficiency. Now, rapid asset growth reflects demand, not performance. NAV and total returns are still what matters the most. So don't get me wrong. This is starting to take off. People are really jumping into it. I personally believe it's that 15%. I believe it's that Berkshire Hathaway trust side of it because the markets have been wishy-washy. What does the program hold? The portfolio is holding. It's a concentrated focus on 20 publicly disclosed Berkshire holdings, plus a core of 10% direct positioning in Berkshire Hathaway's Class B. So take a look at what we have. The earlier 26 exposure featured 38% financials. They've actually walked farther off of financials. They've changed their holdings, which has changed their structure, which has changed, again, the excitement. The Berkshire Hathaway is still 9.78%. Apple 7.42%, American Express 6.8%. You can see what they're holding is different companies that are out there. 72 total holdings, including stocks, options, and cash instruments. Not 72 stocks. The large count reflects an active option overlay engine. Okay, so remember, we have 20 publicly disclosed Berkshire holdings. The total in the portfolio is 72 total holdings, which include those 20 holdings plus stocks plus options and cash. So they've spread their cash spread dramatically out. Active management, the VistaShares adjust the ways in the base, all part of their adjustment and their goal targeting. So the option overlay is really the engine that's driving this and how it works. They write cover calls. The fund write options on individual holdings like Apple, American Express, and then their Berkshire Hathaway Class B stocks. They collect the premiums, the buyers that buy those premiums of Omaha, which acts like a primary source for that 15% payout. And then, of course, they use short-term treasuries and interest to realize capital gains to support those payouts. Now, the premium money isn't free. It comes as a cost of capping the upside participation in strong markets. And as I told you, basically it's this. If they're getting 0.69 basically a month from stock dividends, any interest and all that, that means this engine has to generate 14.31% to hit their targeted goal. Okay, so this is why the 30-day yield means so much, is how much of their money is outside and what they got to do to make it work. So distributions versus the economic return. The yield snapshot. The June distribution was 23 cents. The trailing 12 months was $2.84, which implied a 14.9% distribution rate. So 14.9 to 15%. How many of you would put your hands up and say, close enough? 1/10 of a point is what we got. But the real math investors need to look at and focus on is total return, not just what I call the check size. You need to look at your total return number, which is your NAV change plus your distributions. Okay? For a layman's side of it, trust me, that's me. It's your yield plus your distributions. Excuse me, I'm sorry. Even see how I mess it up. It's your NAV change, which is your growth of your fund plus your distributions. The reason why I'm slipping and saying all this is because the reality check I've done. I don't want to bother anybody. I don't want to put you down for anything, but if this fund pays 15% yield, but the share price or the NAV drops by 8%, your economic return is only 7%. Don't let that 15% fool you. It's masking the true mark of that 8% loss in market share, giving you a real total return of 7%. Now, before I go any farther, I want to explain to people exactly where I'm sitting right now with it. This is the chart that Omaha has had since the day it came out. Okay, this is March of 25 all the way to where we're filming today, July 18th. Now, you will look at numbers now and you'll say, well, what you just said is totally wrong. And you have to make sure you dial things in properly. In 1 year, from March to March 25th to March 26th, the two red lines you combine together gives you where your total return actually established itself. Remember, you're paying a 15% distribution. Love it. Take it all day long. But because the fund lost money and it lost where it was sitting, your actual total return after the first year was just a hair above the 6% mark. Now, depending on which little M button, you got two tall mountains, you can say you were at the 7%, which is what I just showed you. Now, what's happened? They made changes. They changed some things in the fund. Like I told you, that 38% financial, they walked away from that, went to other areas. They're looking at other things, a little more tech with Apple. They're fine-tuning their mix. And now look what you got. The unit is dramatically rising to where now you have a total return for 2026 up to right now established at 17.07%. Now that number is not going to count in the fact that we're not even a full year yet, okay? So what you got to do is you're watching this thing grow. So in the first year, most people will say, Omaha, that was horrible, I walked away from it, and it's gone. Now you start getting the whole bigger picture of everything. Assets under management are growing. Why? The green line. People seeing the change, they like the change, and it's rocketing off back to where it was, to where we're able to actually get a full, true 15% income plus growth, what the original program started. The first year, we took our lumps. Will it continue on? That's what we don't know, but I wanted to show you that part of this. So the NAV stability and the capital preserve are what we're talking about. In the first audit period, total distributions paid was $2.87. Return of capital, they come back and said it was $1.36 of that was return of capital. That engaged in a total return of 6.61%. This is what we were talking about. Oh my God, this looked horrible. This was the fund that we said no way. When it first launched, it launched at $20. It dropped down to $18.35 when they did their audit, and then they started making their changes. Now they're up to $19.04 as of the closing on July 17th. So even though the fund is still down about 4.8%, they've massively recovered from where they were just a few months previous. So this is what makes things very interesting in this fund, that they're actually making changes to try to make things more positive. So as I told you, the benchmarks, this is where I really dial into more of that total return. The performance summary of the NAV, since inception, 12.70% gain. 1 year, 11.36. Year to date, up 6.24. In the past 3 months, 6.16. Now, comparing that to S&P 500, a 6.61 gain to the first auditing period of S&P 500 at 20% growth. You can see you'd be better off putting your money in S&P 500 and being done with it. But you don't get a lot of income from S&P 500. This is what you're trading off, is you want income across the board. The distribution and taxes. This is one that I really, I love this one because it's a great educational. I'll probably be using this on other videos. Look at what was going on. Okay. They have reported 92.3% ROC. May of 2026 was estimated at 92.3. When they did their audit in February of 2026, the return of capital was actually 47.4. The most recent estimate is that the fund will come down to about 37.5. If you've watched my videos before, you'll understand ROC is a very unique piece. It's a very great piece and a negative piece. So many people buy funds and say, oh, it's got ROC, don't worry about it. They're reporting 92%. Well, nothing happens until you get your 1099 DIV form. Everything else is estimates. Okay? Everything is estimates. Now, ROC is not a dividend. It's a classification of a non-dividend distribution for tax purposes. And it reduces your base of your cost of the fund basically until you sell it. It's zero base rule. Once the base hits zero, further ROC is taxed at capital gain income. Monthly notices are estimates only. The final charter appears on your 1099 dividend form. So for fiscal year 2026, saw a 52.6% ordinary income and 47.4% of return of capital. Okay, so if you sit here and take a report of 92%, and I tell you people all this all the time, is that these numbers are estimate. You can't play that. You have to wait till the end of the year. And if you have a fund that consistently does this kind of stuff, you got to remember, you got to estimate your own. So you're getting ordinary income from this fund. It's 47.4% return of capital. So if you're going to use this fund in a brokerage account, you better be prepared to pay some taxes because that 15% is going to cost you. ROC is not free money. It's the fund pays ROC while the NAV is falling. It's literally just handing your cash back to you. This is the double-edged sword we talk about. So the yield trap checklist is the sustainable holdings. Is the portfolio consistent of established, profitable companies linked to the Berkshire Hathaway? Yes, it has. Is it a positive total return? Encouraging that 6.61 total return early in the audit period, despite the slight decline in NAV stat since the inception? I'm going to say, yeah, I think we're in a positive mode. I think we showed that. It's rebounding. Rapid asset scale, explosive growth, and that came from when they made their changes. It improves the liquidity and the operating efficiency, so providing a strong institutional and retail demand. And that consistent payoff, getting that 1.25 is great, but we got to make sure we're getting that total return across the board. So when we talk about traps, the NAV erosion that was out there, it did have some erosion. It did have some drop off. It wasn't just market. It was actually drop off, but they're repairing it and it's coming back. The SEC yield gap, that makes the machine saying this thing has to work hard. Their strategy has to work hard. And they've been proving that it has. But the high ROC dependency, you got to know it's not really true. And the high expense ratio, there's a lot of cost for a little bit of work. So my verdict is this. I believe that Omaha is not a yield trap. I believe it's actually a working fund. I believe it has its ability to do what it wants, but I can only put this into is a satellite only position. This is one of those things that you are going to try to boost your income when your cores are doing their job. The access to your goals is investors seeking high monthly cash flow who understand covered call upside limits and the ROC tax mechanism. It's okay if you understand that. If you got to continuously monitor this one, this is not a set it, forget it. If the NAV erodes consistently while the markets rise, then the yield trap risk becomes a real reality. And the portfolio allocation, this is not a core long-term growth item. This is a satellite income booster, and it's not the foundation to build your retirement portfolio over. That's why I can only say this is a satellite piece at all. Let me know your thoughts about that. Do you think it's is it a satellite? Do you like what since their changes, making some improvements, seeing the growth of the total return? Is that good for you? Or you still say, no, not good enough for us, and VistaShares is just, don't like them. Let me know in the comments below. I'd love to see where you guys sit. So truthfully, across, what you need to watch with this one is the NAV stability. You need to watch your total return, and you need to watch that tax efficiency. If you're not watching these three pieces, then you're not following your portfolio and you got the wrong item in your box. I just hate to say that to you guys. So just don't collect the big check today. Build a dependable retirement paycheck that can last. Omaha is not automatically a yield trap, but it requires continuous monitoring those three critical, vital areas that I talked about: stability, the total return, and the tax ROC. Guys, I want to thank you for watching, and don't be afraid. Leave a comment below. I want to hear from what you guys say, and if you like what we're doing, hit that like button.